Weird flex, but we're kind of good at getting different pieces of trash using different methods out of our Chesapeake Bay waterways. And likewise, when it comes to accessing your cash built up in your universal life or whole life insurance plan, you got to have a good understanding of the different ways available to do that. So let's talk about this. Really only 3 different methods to getting cash out of your policy, one kind of fourth dark horse. The first is what's called a full cash surrender. This is when you cancel your cash accruing plan completely, ending the death benefit associated, and the company cuts you a check for the full cash value balance at the time of your surrender. If you've made a profit on your life insurance plan and you completely surrender that policy, the IRS will treat that profit as normal capital gains, and of course will be assessed a capital gains tax. Second is a withdrawal. This is basically a partial surrender, so instead of you completely dispersing the entire life insurance account, you're only withdrawing a portion of that money, so you're only surrendering a portion of the death benefit. Your death benefit will be permanently reduced by a proportionate amount of the cash that you remove from the policy. And lastly is a loan. This is probably one of the more popular ways discussed. A loan is when you remove cash out of the plan with a promise to repay the company back that money you took out. Like any other loan, the company will charge you a loan interest rate on the outstanding balance due. The reason why this method is so popular is it does 2 things. One, it keeps the full death benefit intact minus the loan balance. So of the ways of getting out cash, it has the smallest effect on your policy. And the other popular feature is that money taken out will be debited in the cash value, but it will not be taken out from your policy value. This is the money that your interest is actually credited on, which means you can still get interest compounding on that money as if you never loaned anything out at all. And the last little cherry on top here with loaning money out is that as long as that money is taken out as a loan and tied to an active life insurance policy, you can take out money well exceeding a profit, which means you took more money out than you ever put in. And the IRS will not charge capital gains tax. And then you've got the dark horse. You can actually sell life insurance policies to investors. This is called a viatical settlement. This is for a select group of older clientele who have health issues, but can be a viable way to get cash from a life insurance plan.